we're about to get another jaw-dropping, dramatic suspension of global economic activity like we saw in 2008, 2009. So we've had a 40-year incredible bull market in US long bonds, and I think that bull market is about to die. Great bull markets end with tales of the unexpected. I call it Mad Max deflation. I see the consequences of malinvestment potentially shaking the foundations of the world financial system. A devaluation, sudden, quick, uncontrolled devaluation in the Chinese currency versus the dollar. That's how I think of a deflationary Holocaust. 2007, the voices were telling me that the biggest banks in the world were going to be bankrupt within a year, 18 months. And I made 50% in the month of October 2008. Markets don't reward logic. Markets reward idiosyncratic drama. If you think the future is inflationary, buy the long bond.
Welcome to the Microscopic Podcast presented by Gold Republic. My name is Alexei Joranov, and in this format I invite you to look at the world through different lenses, to see what's hidden in plain sight. We'll dive deep to understand the forces that drive macroeconomics, financial markets, and the emergence of a new monetary system with sound money like gold, silver, and digital assets like Bitcoin. We'll also investigate how geopolitics and power games shape the world we live in, but also what can we learn from history to understand the present and prepare for the future. This week, I have the pleasure to introduce Hugh Hendry, also known as the Asset Capitalist, the founder of Eclectica Asset Management, who is a prolific Scottish contrarian investor with provocative views on financial markets and with a successful career in macro investing. In this interview, Hugh reflects on his unconventional investment approach, including how his fund made 50% return the first year and predicted the 2008 great financial crisis, resulting in over 30% return on investment that month alone, thanks to what he described as voices in his head. We also discuss why the bond market might be experiencing its last bull run, and why Hugh believes that China will be at the epicenter of a looming cataclysmic event that could result in a deflationary shock akin to a massive global financial holocaust. So, I hope you will get fresh insight and enjoy this conversation. If you do, as always, please give it a like and subscribe, but also leave your actions down below in the comment section and share it to those who need to hear this. But before I start, I'd like you to know that if you open an account at Gold Republic, you will receive 1 free gram of gold worth 60 euros or $50. Just click on the link in the description. Today I'm with the legendary Hugh Hendry, or should I say Jean-Hugues Hendricks.
Or should you say the asset capitalist?
Or the asset capitalist. You're a bit known as being, I would say, like macro misfit. Would that be a good way of describing you, or how would you like to be described?
Yeah, I mean, shit, just spilling my coffee. My fund was called Eclectica, and I think people say, sorry, was it Eclectica or is Eccentrica? You know, it's certainly becoming more and more eccentric over the years. But yeah, I've always had a strong feeling of not fitting in, and I don't think you should fit in. You don't want to be comfortable. I mean, the engagement of speculation, you should feel distinctly uncomfortable, and that was actually something I really majored on, was don't tell me what happens. You know, I didn't want to be, people become 100% sure about things, and to get there, and given the kind of nefarious manner in which you might have to travel, the route planner, the off ramps, there's lots of kind of unexpected detours, that actually sometimes you've got to be able to just suspend and walk away and then come back. Maybe we'll touch upon that, but I can recall back in at the very beginning in the year 2003, and I went on to capture a 50% return in the first calendar year of the hedge fund, and that was exclusively from gold.
Oh, really?
And back then, gold was Bitcoin in the sense of its volatility vis-a-vis the universe, and and lesson to young folk looking to do it. If you get a slug of money, I mean, I started with $30 million, 30. Hat tip to the eccentric community. Find something that's really, really volatile in an emerging uptrend, and then just pray to God.
It's like a rodeo ride.
It is a rodeo.
Literally on the bull.
It is.
Or on the bear.
It is. Yeah.
So actually, I always like, and especially I think in your case, it would be interesting to know is look back a bit more like back then in your youth. Actually, which kind of how would you describe, let's say, your youth? What were the things that defined you the most in terms of mindset?
This backdrop, the sky. There's
the gray sky,
the grey North Atlantic,
boring
North Sea, the grey. You can touch the sky. It's oppressive, and it made me dream and scheme to escape. And many years later, I got to my Caribbean island in the sunshine, and here I am. I've been in Holland for like 2 days. I'm like, I need sunshine. I don't know how you folks survive with the northern hemisphere in winter. Jesus.
Yeah, it's hard.
Wow.
It's hard.
So, my misfit again. I never felt that I belonged, and I didn't know why. But I had the sense that there was more. There was more out there. There had to be more than the grey sky.
So, how did you first then got into, what brought you to finance in the first place?
Serendipity. Literally serendipity. I was, I came from a poor neighborhood. Working class hero. Is John Lennon's song.
Yeah.
Yeah, that's all it is. But I was the first member of my family. I think I was the first person from my school to go to university. And what do you sign on for? You sign on to be, an accountant or a lawyer. What's a huge leap forward from my mother was a telephone receptionist in a little business, and my father was a truck driver. I'm like, I want to be an accountant.
You want to be an accountant?
No, but I was signed up and I was doing accountancy and economics, and in the final year I was who knew I was a smart kid, and I got sponsored by an accountancy firm. They gave me money. I bought a deux chevaux. I got a girlfriend, and I was like, I don't think I'm an accountant. And I really got into Mickey Rourke. Do you remember Mickey Rourke was an amazing actor. Angel Heart. I then became obsessed about Angel Heart, and then I was in my finance major for the honors. I was studying a program called God, it sounds so hideous, but market-based accounting research. MBAR, which sounds kind of like a NASDAQ, not NASDAQ, it was like a NASA program for rocket ships. But it was trying to test whether the market had wisdom, and that the market could the market decipher and filter and determine the difference between an accounting release, a statement released to the general body of shareholders across the wires, that would affect earnings, and you were able to test policy announcements where the commonality was profits would change, but not necessarily cash flow. So if you changed the depreciation, and perhaps you take on a more aggressive depreciation policy, then you would be reducing your profits, but the share price shouldn't change, yeah, because the inherent cash flow is remaining the same, is the logic. And so I would sit there with this thing called a data stream. You know, this was, and the sky was grey, and you had black and green on your terminal, and you would plot these scatter diagrams, and you were looking at normal distributions of stock behavior 90 days before, 90 days afterwards, and then you'd introduce, you know, this news bomb, and then watch like a tempest, watch what would happen. And I became, I think, back to your notion of misfit, that never left me, and therefore I was quite anthropological. Like when I was at university, I didn't drink.
You did not drink?
I didn't. I had no vice. My vice was going to the Glasgow Film Theatre, and a kind of an arts film theatre, and I was obsessed by French films, The Betty Blue and Manon de Source and things like that. And my fantasy escape was I was Jean-Hugues Hendry. And again, the great joy about my life is all of my dreams. All of my dreams kind of came true, but I had no vices, and it was peculiar to be, you know, not typically. It's like it's only if you're a young Christian or something that you're not drinking. I mean, that was not the case, and so I was able to observe. I was fascinated by observations, and so that observation activity really it was a hook for me, and I was like, I want to do this. And I was very fortunate. I already had this grant, and I had a firm job offer from an accountancy firm, and then Serendipity came into my vision, and there was a group called Baillie Gifford, who are now like an enormous, one of the UK's foremost, most successful investment manager for the last 3 decades, and they hired me. Go figure. And they hired me because they were under pressure to diversify their graduate intake. They'd been exclusively recruiting from Oxford and Cambridge.
So it was a quota hire.
Yeah.
You had to fulfill sort of quotas. And
they were seeking to to raise their profile with North American pension fund clients and consultants. You know, like it was a well-oiled, wonderful machine, and so like, you need gene diversity, and I'm like, fine, well, this is good. So,
take the Scottish kid.
Yeah, and it was very, very painful.
In which way?
I was there for eight years. And I'd been kind of super intelligent, super successful.
8 years at the same company.
At the same company. And only because they were kind of aristocratic and profound, like swimming in money. They were super successful. But with the aristocratic thing, no one had like the
device.
No one had the steel to say, get rid of that kid. What, you know,
shovel it out.
And if they'd been less successful, they'd have said, look, tap on the shoulder, it's not working, you got to go. So I was there for 8 years, and it was very, very miserable. Miserable perhaps, but a very intellectually stimulating and rewarding environment, and lots of lessons which stood me. It was a breeding ground, finishing ground, I don't know, certainly not finishing ground, but it definitely articulated the global macro mind that I have. One of my contemporaries, we had this big brothering thing, but from the graduate intake from the year before was Russell Napier. I don't know if you
Yeah, Russell Napier, yeah.
You know.
Okay, so you actually knew him back then already? Because he did some great work on banking, right?
He's a super smart guy.
Super smart guy. Yeah. Also on my list. And so then, like, what then? Like, you said, okay, I need to escape this box that have been like 8 years. I need new horizons, new challenges.
I just had to get out, you know, and you know, like you were in Amsterdam and all these places outside these metropolises, and we stay in these little communities, and we create mythology about the how unpleasant it is. Can you imagine if you had to work in London, you'd have to get up at 4 o'clock in the morning, you'd have to get a train. I'm like, it's nonsense. You go there and like, boom, this is amazing, this is great, if you're talented. And it was hard for me to initially receive a job offer because of just how idiosyncratic, again, eccentric. A word I want to use is eccentric for my career in Edinburgh, because they moved you from geographical region every year. And they didn't want you to focus and be tied to a particular industry. They wanted you to recognize opportunities regardless of geography, regardless of industrial classification. And they did not want you to be beholden to the broker relationship. That's unique in the world of finance. But after 8 years, it meant I had no specialist knowledge. If I had 8 years in the silo of Japanese equities or UK smaller companies or technology companies or pharmaceuticals, I'd have been tapped on the shoulder and I'd been given a great job. And instead it's like, so it was like taking on the Chinese, joining the Chinese civil service. Basically, I had to just, each time I had to write an essay telling prospective employers everything that I knew. And Credit Suisse Asset Management relented. They gave me a position, and I went from like being the, if you will, the 7th sub driver in the number 1 Formula One team, to being on the worst and the slowest Formula One.
Yeah.
I remember I'd go and get a coffee on one of those huge trading floors, and I'd look up and there'd be like 400 people, and like. And there were, of 400 people, there was maybe like 3 or 4 people who were interesting, that actually had that vibration, that actually understood things. I'm not saying they were the 5, there are only 5 people that understand money, but it was that kind of dynamic.
And which year was that?
That was, no idea, that was 1999.
1999.
Or 1998 going into 1990.
So right before the bubble.
It was 1998. 1998, that's when it was. Yeah, the heavens, because I got married in the February. I resigned and got the Credit Suisse Asset Management job in March, April, and I worked with Credit Suisse until March, April of the following year, which would be 1999, and then actually I joined with Chris Benodi, who's now somewhat, it would seem, disgraced hedge fund manager, but he was my finishing school. And here I am many years later, and I just got divorced. Not from Chris Benodi. that came in 2005, but the marriage ended like 3 days ago. So when we talk about this, when we're reminiscing, I'm like, wow,
Oh, sorry for that. But then in terms of experience, because you did also take like risky bets. You saw things that maybe not all kinds of other people, analysts back then, would necessarily bet on. I think in 2006 onwards already, you were seeing like some cracks in the banking system. And correct me if I'm wrong, but you took your balls basically, and you basically saw some trades that you were pretty sure about. But how did you back then already? What did you see, and how did you go about it?
Oh, that's easy. I was a paranoid schizophrenic.
Literally.
I don't know, but let me explain.
Yeah.
Maybe I heard voices in my head.
Okay, literally. Okay, yeah. But have you been diagnosed with any of that?
I'm scared.
Don't say it.
So the voices in my head were a function of the revelation when I met Odie was that he was looking at charts, price charts, and direction. He was looking for momentum, and we and this business is kind of easy-ish, like.
What do you mean by easy?
Well, you buy things going up and you sell things going down.
Oh, how do you know they go up?
But what's remarkable is how really smart people convince themselves to own things which are going down. And I call that the conceit and the arrogance of the intellect. Like, it'll be okay. It's going to change. It's like, you know what? And I did this. I had a huge attempt to be a rock star in Edinburgh, and I bought into Reader's Digest, which had just IPO'd, and I thought Warren Buffett was surely going to buy Reader's Digest. And I put a lot of the firm's money into Reader's Digest, and it went down. And there were murmurings of discontent. And I did more research and convinced myself there's absolutely nothing wrong here, and I bought more of the shares and the considerable funds of the Edinburgh Partnership. And it went down. And I was like, maybe I should go. And I went to Pleasantville, which is upstate New York. And actually, because they spent so much on the US Postal Service, their office wasn't in Pleasantville, but they liked that name and they got to use it. Anyway. And I bought more. And it kept going down. And eventually, the partners are like, dude, you are so wrong and you're so right. And thank goodness they did that, because it went bankrupt.
Oh, wow.
You see, why didn't I wait till it went up? You see what I mean? Like, the impatience, the arrogance, the conceit created by this mind that believes that it's seen the future. The only thing that's seen the future is the share price is going up. And then, there's certainly not a science, but, there's the deliberation of trend is the trend changing, etc. And that eventually that becomes experience and touch. But Crispin had that. And so the voices, so back to the paranoid schizophrenia, the voices was very much a function of looking at, I had a pipe from Bloomberg, and I could bring I looked at charts of everything in the world. There was not a stock market or a commodity, anything that was publicly trading, I would be aware of the price. I call
everything
it chart porn, and I had a very precise idea of what I was looking for. Mm-hmm. I was looking for businesses that had endured a bear market. They had fallen, they had underperformed, they had disappointed legions and a generation of investors, and investors become emotional. Like, I never want to hear about that again. And then with no one watching, they rehabilitate and they come better. And so there was a footprint of things that I was looking for. So that was the voices. And in the early 2000s, the voices were saying that I was to buy commodities, commodity futures. And I was to go into the stock market and find anything which was a proxy for the commodity market. And the challenge was to take the voices. And I was aided and abetted by effectively an intel team, like really, really smart, orthodox minds. And it was like, the voices are telling me to do this. Can you go and corroborate it? I'm buying it anyway. But if you can corroborate it, I'll probably buy more. And the corroboration was the emergence. China had started off the size, the GDP of Turkey. Like, Turkey's GDP today is about $1 trillion. And China now has the GDP of Europe, is $18-19 trillion. And that pivot point was beginning to impress and touch and distort and form a new price dynamic in the commodity market.
Was it like back then, like considered as like a mini commodity supercycle, or how would you describe it?
It was the emergence of a commodity upcycle again after the crash and burn from the 1970s, and so I was very. Our portfolios were resonant with that. We understood why, and we owned the worst, shadiest commodity businesses in the market, in case we were right. And we owned the dullest, best businesses with a commodity exposure, which back then would have been a Phelps Dodge in America, Rio Tinto, Billiton, BHP Billiton. They'd have been separate businesses back then. And we owned them in case we were wrong, the old Soros logic. And I happened upon gold because, like I say, it was the most volatile of the asset classes. And what had happened was I would look at the trace like, again, so think of me at university and I'm watching the Tempest, and then we're dropping in this accounting thing, and will the market play, will the market get it right? And I'm watching, voyeuristic out there on the perpendicular. And I'd been looking at the performance of gold vis-a-vis the S&P. And this is 2003, yeah? And you'd had the NASDAQ collapse from March of 2000. And pretty much stock markets had fallen between 50 and 80%. Gold did nothing, as was its habitude. You know, gold had fallen from $800 in January of 1980, and it was $300 in 2003. But just doing nothing when you had this sea of carnage meant that on a relative price basis, it was actually doing something really very, very provocative. And so the voices were like, we need to own gold, we need to own gold, we need to own gold. And that's why it did. And then the vol just meant that you could supercharge returns. And you said risky. There's nothing risky about having, far from it, there's nothing risky about having provocative views. I'd actually say it's less risky because views which are provocative are priced to be wrong. And so the consequences of being wrong are already priced in. It's like, okay, nothing happens. Yeah, that's the default. Of course you were wrong, dummy, move on. The greatest risk is buying the 7 stocks. You know, there's 2 stock markets today. There's the S&P 493 and there's the S&P 7. Yeah, all the risk is in the S&P 7. Yeah, I mean, if your proposition, if your premise is wrong there, you're going to be punished. So there's nothing wrong in terms of risk taking with regard to the contentious nature of your premise. But boy, was I taking risk because there was no vol adjustment. I was owning. I was leveraged. I was probably 2.5 times a long exposure to an asset class which had a price volatility of 2.5 times that of the S&P. Yeah, and you could say I was lucky. I was tenacious. I remember closing everything. So again, I think I was talking about earlier, I was like, I had the ability, the path became torturous, and I was very worried. There was a point in 2003, I was down 15, going on 20%. How'd you come back from that? So I was like, you stopped digging, and I closed and I walked away, and I started investing in a sausage condom manufacturer.
Sausage condom manufacturer?
Yeah, so it's...
the fake, okay.
The collagen.
Yeah, okay.
Collagen. Yeah,
so
yeah.
what's the ball of the pig used for, and it's like a substitute?
It used to in a delicatessen, it will be it will be that.
My grandparents are butchers, I know.
Okay. And so there was a Scottish business called Deverell, and again, I was always looking for things that had collapsed, and then I was willing to give them a second chance, because the voices would be telling me, okay, like we're in the forgiveness stage of the cycle. I always participated in the forgiveness stage.
So that's interesting. You talk about, so that's the forgiveness state of the cycle. So what are the other parts of the cycle? How would you call them?
Well, I mean, but you know them. They're all part of that. The
boom and bust.
Well, but also it's the emotions of loss.
Yeah.
Emotional loss.
The 7 griefs. The 7 stages of grief.
So I'm not. Markets are kind of these mechanisms which kind of breathe, contract, expand, contract, and they have cycles. And I was just very cognizant of cycles and emotion. So my portfolio construction was very risky. My premise, being contentious, was not risky. Late 2007, the voices were telling me that the biggest banks in the world were going to be bankrupt within a year, 18 months.
So just to understand, maybe
as we move forward from the beginning of the century to
the voices being kind of like unconscious, puzzling things together. If let's say we want to rationalize like the voices, because the voices sounds a bit mystical almost. It could be like,
it's a mystical it's a mystical damn process.
No, really. Like, can you now pinpoint like what those voices are? Or is it more of a hunch, or
insanity. But we can quantify in that you can look at my investment letters to clients every month I had to publish, and it would be a narrative, and eventually it went on to become like people wanted to read it because it was kind of crazy.
You did say my voice has told me this one.
Well, but clearly it had insights, and people would say logic and wisdom. But I had to publish my 5 biggest risk positions, and in 2003, apart from gold, my biggest risk positions were being short Fannie Mae, Freddie Mac, Countrywide Financial, Washington Mutual.
Like all the insurance companies and the insurance.
I just listed like the biggest bankruptcies in 2007, 2008, and I had them as my biggest risk short positions in 2003. Now, I closed them. Remember, I have the ability to be dispassionate. Perhaps that's the wrong word. I am very fearful about death.
You are.
Yeah, aging is not something that rests well on my shoulder. Maybe you might be able to guess that. I'm young at heart, but very, very fearful, and so I will do anything to try and stave off. And I want to die another day, and so legends about my career. I was the centipede. Centipedes are slow, but centipedes have supposedly 100 feet, 100 legs. Yeah. And the notion was, if you've only got 2 legs and you're in a jam and you got to lose a leg, even if you're in a jam, I'm going to go, I'm attached to my legs. I'm going to procrastinate. Yeah. If I got 100, I'm like, fuck it, I'll lose a leg. Yeah. And I needed that kind of lose a leg. Keep moving forward. The French Legion, if in doubt, move forward.
Yeah.
Always take action.
Yeah.
So that was very, and so that allowed, so with those short positions, they were maybe premeditated, but they were too early. But clearly, the fragments of my consciousness was being formed as far back as 2003. But it became a profoundly large risk position within my portfolio from April of 2007 onwards. And really, the first real flicker in the portfolio was seen at the end of February of 2008. The portfolio was up 25%.
Wow. Because
we had seen the demise of Bear Stearns, with us for, 58 years, gone in 58 seconds kind of thing. And listen to me, I was up 25% in February, and I should have gone, take my chips, I'm out of the casino. Folks, I love you. And I didn't do that. And I went from up 20% to down 20% in a torturous journey. I've been discussing it at the Amsterdam, the panel I did with the Bitcoin community, being an enemy of the state, in actually knowing the shocking truth of what's going to happen. Yeah, I've seen science fiction movies where there's like 50 people and the scientists, and they know that the Earth's going to explode, and it's going to explode in 18 months. But the intelligence services, you can't disseminate that. If you disseminate that, you're going to lose control of civil society. And it was had those parallels. And so the torturous journey was that because the truth was so unpalatable, the authorities went out of their way to make it very hard for that truth discovery to actually elicit a profit. And I, at the very end, I thought I was busted. I was like, do I write a letter resigning, or is too late for that? And finger to everyone, and see you on the other side. And I chose the latter. And there was one day my portfolio lifted by $100 million in overnight, which was the bankruptcy of Lehman Brothers.
Oh, so that happened, and afterwards, you had a 20% pump. That was the first.
I was up 20,
and then down 20.
I was flat. I was down 20, and I closed the year up 32%. Yeah. And I made 50% in the month of October 2008. Paul Tudor Jones made 50% in the month of October 1987. And rightly, he was proclaimed as a genius, and he is a genius. And And there's a lesson to the folk out there. You might not know this, but there's an amazing public broadcasting services documentary of that period with Paul. And it's so revealing, it's so amazing, it's full of amazing color and insight about the person. And there's something about becoming rich. You just don't want people to know, to know the truth or to get too close to you. And he has done everything to buy up all of the rights to that, and it's really, really hard to find. But every now and again, a roguish copy goes on to I'm not the person sending it, but there's a roguish YouTube. Look out for Paul Tudor Jones, 1987, how he made 50% in the month of October. He was working with Soros, and I can't say they got lucky, but it's preposterous. They had good principles, but they were working on an analog, which was the markets seemed to be moving very, very similar to an analog of how the Dow Jones just before the crash of 1929. So they were looking at, they were taking that analog of the 1929 Dow, and you were looking at it X minus 180 days, and the analog was just working very, very tight with 87, and they just had a huge risk position, and boom. I made 50% in the month of October, and no one said I was a genius. They said I was a dumb idiot. Paul Tudor
With the
Jones.
same bets that were deemed risky right before that.
Weren't deemed. The bet, I mean, so my bets, so I made 50% in that month because I had, and by then it was so late in the campaign, and I was like, I had no nails left, and I was convinced that the bad guys had won. And anyway, the sun was going to blow up and we were all dead, and I was like, bugger. The worst that could happen to me was I had 12.5% of the fund invested in swaption premium, and that swaption premium would have revalued to zero. So I'd have lost. My max loss was 12.5% of NAV.
Okay.
But I was already down 20%, so I could have been down 32%. So it's a bit like where I am today. Fast forward to the present, and I'm down like 20% in the last 3 months on ownership, intellectual ownership of the long end of the bond market, the TLT.
So that's an interesting segue.
And I've got a call option on that, which is kind of similar to where I was back then.
Yeah. So now it's like a repeat, kind of like a scenario of like back then.
And reports of my death again are being grossly exaggerated.
And so what is the setup now, and what do you see now, what you back then like those voices telling you?
So maybe I'm caught taking too many talks on the same pipe, but one of my mantras from about 2006, 2007 was, if you think the future is inflationary, buy the long bond, right? And that makes no sense.
Why?
If you think the future is inflationary,
You price on
go long the nominal bond instrument, which is the most price sensitive to CPI, to inflation, right? So if the future is inflationary, the long bond will be destroyed. So I'm saying, if you think the future is inflationary, it's a bit like, crucify yourself, like immolate yourself. Like, who chooses to do that?
Yeah.
But there was a curious form of asset capitalist logic, I think, which was that, because I was actually motivated with, in 2006, I think you saw like really, really bullish calls coming out of Wall Street strategists on gold. So the people who had denied it, people who weren't there in 2003, were suddenly saying it was going to trade at $3,000. And, maybe, but the way I said to myself, I challenged myself, how could gold trade at $3,000? How could this be right? Because like their reasoning is nonsense. How would you make that happen? And I reasoned that you would require a revolution in risk-taking, a revolution in reputation with the central bank. And that these like really sober, conservative, white males back then, now we got, Christine and and the Sunshine Gang and all the rest. And we've got, grandmother Janet, and she's yelling, and anyway. But it would take the mother of all deflationary shocks to turn that crew into the rock steady crew who are like, hey, let's shake it up. Yeah. And so you would need deflation. You need a profound sense of deflation. It was the deflation where you would monetize, obviously, where you'd make money from the long bonds. So the trade was, we're going to have a really shocking recession brought on by an asset price deflation. And it was clear it was going to be in housing. I'd already been writing in these short positions from 2003. The market was, and US house prices had already started falling as early as 2006. So there was so much writing on the wall, the damn wall fell down. Yeah. And that was why I wanted to own bonds. And I was right, because all of that came to play. The Fed went from 5.25% to 0 interest rates. Never been at 0. And of course, in March of 2009, they launched quantitative easing. So I was right in a lot of things. My application, in terms of my risk application, was mixed. I clearly did well in 2008. But within that, I'd correctly recognized that gold would actually be a source of liquidity. It would be sold to meet margin calls, and it wouldn't perform well. And boy, was I right about that. Gold fell from 1,100 to 650 maybe in the fourth quarter of 2008, early 2009. I should have been buying. I kicked myself. I didn't buy it.
You weren't buying.
I didn't have it. I didn't own it.
Okay.
I didn't own it, but I should have bought it. And then in March of 2009, I kicked myself. I should have owned S&P. S&P fell 58.8%. Let's call that 60, right? You buy that, yeah? I didn't buy it, and that's a great regret. So I believe that there's a notion of mean reversion, which is true only at the real core of the system. In the core of the macro universe, you have the S&P, treasuries, you have alternatives like gold, and you have cash. And cash, you can bring in currencies there. And I think mean reversion has a place in these kind of cardinal points of an investor's map. It has no place in trying to buy bottoms in stocks. There's too much idiosyncratic risk. But in the cardinal points, I think it's very, very prevalent. And so I promised myself the next time I saw that, I would be there. And I'm there. We've the treasuries. So if we have this quadratic expression of the macro universe, we discussed the S&P. It fell 60%, and it was ultimately a buy. The long end of the bond market, if we take we take it as manifested by the TLT, which is a passive ETF with an average maturity of maybe 17 years. It has fallen. It's halved in price. It's more than halved in price. It fell from 185 to 85. In terms of price gains, it's taken all of the price gains since 2004. In 2004, I was short Countrywide Financial, Wells Fargo, Fannie Mae, Freddie Mac, and we had a profound deflation. And I'd say we had a deflation which created the depression that we live under today. The depression that people don't recognize, are not allowed to discuss in the media. And all of that bond price has been removed over the same period. The S&P is up 4 times. The S&P and the price architecture of equities is determined by the risk-free duration price of money. And the risk-free duration price of money, the ultra long end of the bond market.
So there's disconnect basically, like there's a total decoupling.
I wake up every day in my French sunny island. I'm like, with a coffee, I'm like, is the S&P down 20%? It's just 1987, Paul Tudor Jones. It's going to happen again. It's just completely disconnected. But so the logic and joining dots with 2007, 2008. If you think the future's inflationary, buy bonds. and I'm working on that basis again, I think people have gone too early. So we've had a 40-year incredible bull market in long bonds, US long bonds. And I think that bull market is about to die. But I think it will die with a
bang.
With a drama and with an... there was a TV program, God, in the 1970s in the UK. It was called Tales of the Unexpected. And great bull markets end with Tales of the Unexpected.
Like a massive firework, if you want so.
Like, logically, it should die here, with where debt to GDP is, with the schism in US politics.
All-time high debt levels.
Yeah, and like no plan to reduce it. A Fed that kind of, if it could, it would push rates higher. The whole thing is ready to, to be very inflationary, and the long end should die here. Markets don't reward logic. Markets reward idiosyncratic drama. And so I think what you're going to see is, and not drama just for the sake of drama, drama based on logic, forgive me. The greatest...
Like doom drama, drama.
But there is a doom logic, okay? And the doom logic, again, goes all the way back 12 years to the crisis of 2008, which took the Fed and the dollar to be a funding currency for the rest of the world, where the carry was zero. And the expectation was that the dollar would weaken. And so you were able to borrow in dollars, your carry was zero, and you would probably, when you repaid it in your foreign currency, which you would have required less to repay these devalued dollars. And that all came and worked its way through what we call the Eurodollar system, which is a kind of black, kind of Bitcoin-esque credit allocation, credit provision system, where the majority of money which is printed not within the sovereignty of the United States, but it's printed outside. A lot of it's printed out of Japanese banks, creating dollar liabilities. And it created the serial expansion in the GDP of China, which was a GDP expansion which was fake. I say fake in the sense that it wasn't associated with the creation of wealth. In fact, at the end, it was destroying wealth. It was growth at the expense of wealth. And I don't think that's a bold claim. If you look at their risk assets confirm that. The share prices have done worse than nothing, because there's been no wealth creation. And you've had there are bubbles everywhere, but the mother of all bubbles is the Chinese property market. $60 trillion. So just seen country gardens.
Country gardens, exactly.
These are
what Evergrande read before.
It's bigger. Their debts are bigger than the sovereign debts of Argentina.
Yeah.
They're huge, and that's just two players. And so the China of the last 15 years has been predicated on the wrong assumption. It's been predicated on the Fed at zero, on ZERP, and the Fed's at 5.5%. And clearly, so the US kind of okay just now, because who knew, but during the COVID, we finally got a vaccine for the invasion of the body snatchers, for the virus. But at the same time, they started handing out a vaccine against the Fed. I missed that. In fact, I didn't miss it because I had it.
What do you mean?
I got a vaccine against the ECB because I'm borrowing in euros in St. Bart's. What do I mean? What do I mean? I mean everyone refinance. So in the US, the majority, you could refinance for 30 years. I can only refinance fixed for 30 years. Fixed for 30 years. I'm fixed for 20 years.
Wow.
With French banks. That's the norm. 15 to 20 years is kind of the norm.
Yeah, but at those rates, will we ever see those rates ever again?
I think you will. I think they'll be fleeting, but I think you'll go back there and that would be the drama. And let me tell you why. That's my thesis, that we're about to get another jaw-dropping, dramatic suspension of global economic activity like we saw in 2008, 2009. And it's coming at you fast and furious from the Federal Reserve. So that the vaccine notion. Forgive me for being playful, but the U.S. private sector has proven to be robust, and the private sector in the U.S. immunized itself and defended itself against the randomness or the vengefulness of the Federal Reserve. Federal Reserve went from 0 to 5.5% rates in
Fastest
18
hike
months.
ever.
Fast, biggest hike ever.
Ever.
Why? Because everyone was paying fixed for 30 years. There was one agent that forgot to fix, and it was the US government. And all the stress now is being felt at the core of the system, which is the US government. And that is profound and serious. So I think to the notion, buy the long end, buy the TLT, buy the tilts, if you think the future is inflationary. So let's answer the future is inflationary. Why? Because the collateral of the modern banking and credit system is the US Treasury. And so US Treasury is what gold was back up to the Great Depression, up to the market. I think there are huge parallels. It was, gold expands slowly, really, really slowly. And treasuries were like that, and there were kind of finite limits to where the US government would borrow, or perception of finite limits, which was kind of used to be 40, maybe it was 60%. Now we're double that level, and now we've got rates where they just can't meet their budgets. The economy is booming, and they're running a deficit of 9%, which is to say and because they didn't issue 30-year.
The fiscal deficit.
The fiscal deficit,
and the trade deficits.
The trade deficit is not their responsibility. The trade deficits.
No, but if you look at the economy,
but the trade deficit is an exogenous factor determined, I think, by nefarious trade practices being conducted by principally the Chinese. If the Chinese target a trade surplus, the US and the modern international trading mechanism the US will have no choice. The US will record a deficit. The US doesn't volunteer for deficits. It's imposed. The trade deficits are imposed on the US by the decision of other sovereign nations to target trade surpluses. This is the money creation which has created the overvaluation of everything. So the recession that I see is the deflationary stroke depressionary recession that I see is a devaluation, sudden, quick, uncontrolled devaluation in the Chinese currency versus the dollar. So because it has to unwind 15 years of profound excess of borrowing in dollars in projects which have not created any wealth, they've destroyed wealth, and they have to be repaid. And this is why you're seeing the dollar index at 106, 106 and a half. And I think the peak was 115, the modern peak. The previous peaks, if you go back 25 years, I think were more like 125. I think we're going to trade 125. I think we might trade 135. And that's an environment where I could see the long end of the bond market. So that TLT, I think it's going to trade somewhere between 160 and 190. And today it trades at 85. And in the upper echelons of that range, I will be buying long dated, at the money, puts, and I'll be calling the end of the bond market.
Wow. So the end of bond market would be, because you could see the bond market is the biggest market of all, right?
It's the most important market.
It's the most important. The bond market is never wrong.
Determines everything.
Exactly. So what does it say about the system if that is about to massively implode?
Well, it tells you that it feels like it's 1929 and that we are going so we had a gold standard, right? And then we had war, and then we had the Bretton Woods system, which was like, we got to do something. The gold standard broke, it didn't work, and it created overvaluation and everything. And then when it broke, we couldn't control the fallout, and so you created Bretton Woods. But at Bretton Woods, Keynes was saying, this doesn't work. Okay, that what you're doing is you're actually within the Bretton Woods, and indeed. Bretton Woods was, the IMF and sovereign, the SDRs, these illiquid, it was a damn silly system. It was created, and the private sector via the banks came in and said, okay, we're going to take Bretton Woods, but actually we're going to impose the Eurodollar system, and we're going to make it work. We're going to make it practical. It was a very ideological system, and we're going to make it an ideological. Ideological is not a term I want to use. Actually, it was devoid of ideology. It was a fanciful, positive spirited policy, but it had no practical application in the real world in terms of credit creation and the ability to govern the relationship between sovereign nations. And so it left a huge gap for the private sector banking community around the world to come in, interpret, and make it work.
And that's the shadow banking part.
That's the Eurodollar system. But the Achilles heel of that is the same Achilles heel of the dollar. And when I say Achilles heel, I want to challenge that actually. It's just that the system and the system weakness that Keynes recognizes that it's prone to cheating, sovereign cheating. So within the gold standard, gold was meant to be accumulated by the nation that was running trade surpluses. The accumulation of gold would be the accumulation of high-powered money. Gold is essentially you can then credit leverage the private banking sector. It's the liability of the private banking system, but it has the ability to credit leverage and make loans against it, and then become very super profitable. And so the more that you are trading positive surpluses each year with the rest of the world, the more high-powered money, so the more credit expansion is coming into your economy, and so the faster the rate of growth is, people are becoming richer and richer within your economy. And the presumption is that at some point, your prices will be rising, you'll be less competitive with the rest of the world, and this great trade surplus will mean revert, and you'll be a deficit, and then there'll be salvation to the rest of the world. The US Fed rejected that mechanism, and it immunized
Under
them.
which grounds?
The economy's booming. Our economy's growing at 4. If we throw more credit on it, things going to go crazy. And so they actually prevented the gold going into the system. And so what you did was you perpetuated for the deficit nations, which was predominantly the UK, they suffered like a depression. And so actually the perversity is that when the crash came, the UK was released, and the 1930s was a lot easier than the 1920s to the average British worker. So the prevalence and the existence of Chinese surpluses for the last 20 years just tell you that the Eurodollar banking system has the same weakness as the gold system. And it creates an overvaluation, and things will break, and we're at that breakage. And to the point and the question that you asked, what does this all mean? It means that sovereign heads of state, when this all tumbles, will have to get together and say, we need a new plan.
And so what do you think is that new plan going to be? Or
I'm waiting for them to call me. Actually, it's very straightforward. You just have to insist that there's no reward to cheating. That if you are, China's producing trade surpluses with the rest of the world, which are greater than 1% of global GDP every year. Right? And they've had 25 years of like that, so that's 25% of global GDP, plus. And you put, I don't know, like you'd have the IMF, and you'd 3 years of consistent surpluses, we're going to talk about it. And it's easy, so you have 3 years of surplus. The question would be, you wouldn't even have a committee. You could, we could just design a piece of logic software. Okay, flag 3 years of trade surplus. Then you'd have is it significant at the world level in terms of what is the surplus to global GDP, and choose a figure to make it relevant. 25 basis points? I don't know. And the next level of engagement and curiosity would be, what has your currency done? Has your currency appreciated, gone sideways, or depreciated? Okay, and there'd be 3 nodal points where you would separate. If it has depreciated, we're going to have to talk. Yeah, because we've allowed that scenario. So I said to you that China's gone from being the size of Turkey to being greater than the size of the European continental shelf. Okay, it's done so because it reorganized itself, it embraced capitalism, and prior to 2007, 2008, it had an incredible allocation of capital, very wealth-creating capital deployment. The currency should have appreciated. So if we go back to 1994, you might be saying, are we just choosing random dates? 1994 was the signature of the North American Free Trade Agreement between Canada and Mexico. China saw that as a huge threat and it devalued its currency. From 6 to 9.
But it's done ever so. I mean, they're like relying heavily on exports.
Everything's gone right for the Chinese and their currency has devalued.
Yeah, but now they actually might be the epicenter of the next crisis, as you just mentioned earlier.
And then, again, there's always parody that, parody or paradox perhaps, because the US, there was a great means of dealing with the cheating coming out of mercantilist nations, which was that they had an insatiable appetite for risk-free treasury securities, and therefore there was a moment in time, especially around the year 2000, so the emergence of the new century, the US should have had the golden opportunity to run budget deficits in the order of 10% of GDP every year and build out, like copy the Chinese and build out the best infrastructure, repair the malaise in its education, repair the malaise in its healthcare system, have the best broadband, and it would all have been financed by the Chinese, and it didn't do it. It ran fiscal. It ran fiscal conservatism. It didn't produce the deficits. It didn't produce the paper, the risk-free paper that these sovereigns so desperately wanted. And what happened was JP Morgan and Citigroup, Wall Street stepped in, and they created the paper. And they created the paper through mortgage-backed securities. Mortgage-backed securities were perhaps even less risky than the risk-free rate because no one defaults on their mortgage. US house prices across the board never fall collectively. When you create a diversified portfolio of these units, it's less risky than the US government, was the presumption. Okay, so
the housing was the safest market back then.
And they sold $5 trillion of those securities. That's $5 trillion that actually they wanted to give the US government, the $5 trillion that could have been invested when GDP for the US economy in the year 2000 would have been, today is 25 trillion. I want to say it would have been closer to 15 trillion. So you had a third of GDP you could have been spending making, what's the Trump thing, make America great. They actually passed on that opportunity. The Chinese were willing to do it. Now they understand the opportunity, how the international trade is set against them and how they can profit from it. Mm-hmm. And now they're running these trade deficits, but it's at a point where the Chinese model is no longer working and they're like, we have no money to buy risk-free securities. Mm-hmm. And but the message is there's a disconnect. We have no money to buy your US securities. Oh, we should just spend, we should be running deficits as high as anything. We have no money to buy your securities. We should be running deficits, and that's the that's the dissonance, which is the danger, the fault lines in today's mm-hmm. markets.
So to come rewind a bit. So if I understood properly, you foresee a big shakeup in the property market in China. That's going to happen in the next coming months. We already see
a shake-up in the property market. I mean, the property market. I mean, they're not going to bulldoze apartments or anything. I see the consequences of malinvestment potentially shaking the foundations of the world financial system via its influence on the dollar renminbi or the dollar yuan mm-hmm. rate. Mm-hmm. Dollar yuan trades around 7.3, and they're spending a lot of their reputation and they're doing a lot of tinkering with the Chinese banking system to hold that level. And if it breaks, I think we go to 8 and I think we go to 9. And at 9, the world is I call it Mad Max deflation. Think of the original Mad Max with Mel Gibson and that. That's how I think of a deflationary Holocaust.
Really?
And that's the environment where the long end of the bond market may touch the lows that we saw during the pandemic, but that will again bring forward another revolution in central banking. They'll become even more risk-seeking. God knows what.
Can that be? Yeah.
God knows what that'll be. Don't ask me what that'll be, but they'll be even more risk-seeking because it will feel like the end of the world. So, like I say, I want to own the most despised asset, of course, in the macro atlas, the macro compass, is the treasuries. I want to own it. And then I want to sell it when it's the one where everyone's saying we're doomed and they're owning it. I'm going to be saying, I'm out of here. and the big question, and you're going to ask me, is I'm going to stop you because I don't know what I'll be buying. Obviously, I'll be buying real assets, but trying to work out. I'll be buying real assets.
Yeah. But still, the future is inflationary. So there's a deflationary shock, but then after that follows like another set of waves of inflation, as we've seen in the 40s.
But this is the final stage. So all of that is, again, forgive me, it comes through the filter of me. Right? Yeah.
Go ahead.
But what people still don't get is how difficult it is to produce inflation. So like people think we've got inflation and they say, hey, oil's at, briefly it was high 90s. High oil prices, inflationary. High oil prices are not, that is not inflation. That is an elevated price series in one important commodity in the world. It is not general price inflation. General price inflation is something remarkably different. To create general price inflation is profoundly difficult because the capital markets have built, again, I use the word immunization, they built fire breaks to stop elected politicians blowing the thing, because that's where they want to go. But actually, if you appoint the president of the United States, say, hey, create hyperinflation, it's nigh on impossible without the consent of the treasury market. We control our destiny. So what I mean by that, we thought we had I don't think, but the transitory inflation. I was in the transitory inflation. Paul Krugman had a tweet last night, which is asshole-like, in its,
it's over
language, but it's over. But
that's 3%.
I agree. And actually, I would say it's not over because I think it's good. Prices will be negative within 2 years.
Yeah.
Before 2 years, they'll be negative. So I mean, who's the asshole, Paul Krugman or me? But yeah. So.
Then core inflation or just headline inflation?
I remember. I'm telling you, like.
Yeah, no, of course.
I'm
we just
talking about an environment where the CNH might trade 9. And what I'm saying to you is, so why did all that pandemic spending, all that sending people money in the post, fiscal deficits, and US inflation got like 9, and now it's got a 2 handle, and I'm saying within 18 months it'll be negative. See how difficult it is to actually sustain inflation.
But even with like all those forces of deglobalization, for example, of rising discrepancies of logistical chains, all of that fiscal spending, it still won't have any impact on inflation.
Ask yourself, tell me, what is inflation?
Well, it is, if you look at it in a certain way, it's the money supply increasing.
It's a monetary phenomenon.
Yeah.
Okay. Why is it a monetary phenomenon? Let's use your phone because this is
because you like my phone apparently.
It's a smaller version of my phone. Although you've got tropical pictures as well.
There you go. That's what I'm dreaming about in rainy Netherlands. Yeah.
But it's the modern wallet.
Yeah.
Okay. And so it could be the economy, and money comes into your wallet, and that's what you earn pretty much, yeah. Another source might be you could borrow money and you might have some windfall gains, okay? And then you've got your consumption of goods and services, and you might keep a little bit back for savings. But so the outflow is your consumption. Yeah? And the cost of consuming what you did last year goes up 10%, but you don't get paid 10% more. And you go to the bank, you ask for a loan, and like, no. And there are no windfall gains. So what happens? Okay, you spend 10% less, and that's why we have a debate between expenditure being discretionary and non-discretionary. And non-discretionary is heating the house or the AC for the apartment. It's healthcare bills. It's food. It's the gas to get you to the office and back. You can't scrimp on that stuff. That's what you got to pay. Your Netflix subscription. The pine cone. I call him the pine cone man, but Bill Ackman, he buys Netflix. During that period, now you discover actually that's one of the things that you discover you can do without. It's discretionary spending. So inflation is hard to produce, but it's governed by the Treasury bond market. So we've gone to where interest rates are. No economic activity can take place. So the US economy is going to reach a point. The delta, the rate of change, is determined by spending more. Okay, people are not moving house because you would then have need for a new mortgage, and you'd reprice from 3 to almost 8%. No one's volunteering for that. If you are looking to buy something, then you have a mortgage which is close to 8%, which means you can't afford the last 5 years of price gains. So nothing's happening. And again, that's relevant because the US residential real estate is $55 trillion. And it's not trading. So 55 trillion is a fake mark. And you might think that a 10% drawdown on it would probably get prices moving. And 10% would mean that some hot areas might be down 25% and other areas might be down 5%, and the average would be 10%. That's a $5.5 trillion mark-to-market loss on residential property. And then there's almost certainly that, if not more, on commercial property because of lifestyle changes with COVID. Then there's the Amazon effect, so like retail and mall. That could be another $5 trillion. There's a lot of people are not spending money at the margin, and we're going to see that. So I think because the delta requires financing, and the financing rate discourages economic activity. So at some point, this kind of stationary economy will be the delta, and the delta is zero, and you'll be in recession. So that's created by the Treasury market and the repricing of credit. Credit is really, really high.
So in a way, we could say that maybe because the US consumers accumulated so much savings in the last abnormally, right? It's almost inverted actually, right?
Given.
Yeah, given. Yeah, like what you said, like the postal checks and so on. That it took so much time for inflation to actually even go down, even though there was such an aggressive rate hikes from the central banks, especially led by the Fed, that all that actually is now over-exaggerated because it will anyways end up in a deflationary shock.
Well, I'm saying to you that prices went from nothing to almost 10%, but then very rapidly dissipated.
Yeah.
And they're unlikely to go back to 10 or 15% in some kind of analog of the 1970s. I think one can be confident about that because credit expansion in the US economy is zero. And we know why it's zero, because you need 8% for a mortgage. You need 12% to expand your working capital. You need 12% if you're going to take on a new car loan. And no one's volunteering for it. It's the wrong rate. And so the economy can't sustain. It can't sustain the cost of credit, which is being imposed upon it by the Federal Reserve and amplified by the sheer size of Treasury markets. And so between the Fed and the Treasury market, we're restraining money, and the restraint of money will be what is the victory over the inflation that we saw during coming out of COVID. But what I'm saying to you is that if the world becomes profoundly bleak in the manner that it did in late 2008, and if the treasury market is at 50 basis points, if the long end bond market is priced at 50 basis points, 10-year, the authorities then have got a green light to spend, just spend, and that could be the environment which creates the money printing, which would then facilitate an inflation. But it's even then it's a big if.
Can we convert this to maybe like Japanification of it as well?
Oh, we've done all of that, and so the Japan thing, Japan introduced quantitative easing before everyone else. They've had 27 different versions, which is to say it doesn't work.
Of quantitative easing.
Yeah, so quantitative easing is the printing of tokens of latent money. It's there.
Latent?
It's latent.
Latent. Okay, delayed.
Reserve.
Yeah.
And it's a bank reserve which can be used to facilitate lending. But there's been no animal spirits or desire to engage in bank lending.
No productive lending.
Lending.
Yeah.
Lending.
Well, you could be, as you said, you could be lending to basically companies that are zombie companies. You could basically it's all like 0%.
But above and beyond that, there's no great desire for the money, and there's no great desire to facilitate and to print the money. And so I think of it as being like an igloo, which is being doused in paraffin, and you keep swapping. Both of us are inside and we're freezing our asses off, and I give you the lighter. I'm like, go for it. No, you do it first. Maybe Japan actually, because we're talking about the yen, which is devalued the best part of 40% in the last 18 months. Wow, yeah. Does that mean they actually clicked the lighter? What would be the mechanism? The mechanism would be that they actually took all of that latent money, these JGB bank reserves yielding nothing, and they used it as collateral to borrow dollars out of the Eurodollar system. And with dollars, then they were addressing the shortage of dollars coming out of China. And then they took on a dollar short position. They took on credit exposure into China, and that seemed really safe because China was like the biggest, fastest growing economy. And let's predate this to 5 years ago, and they were following all their biggest domestic industrial clients into mainland China, and then that Chinese housing market, the demise of the dollar is very closely aligned time-wise with the emergence of the Evergrande and all the other stories with property. So it may be that Japan was the first to monetize quantitative easing, and we may be on a slide with where dollar yen is 150. And such will be the desire of the Eurodollar. The banking counterparties to Japanese banks will be saying, you're over, I'm calling you, I want dollars. And maybe dollar yen is going to go to 300, 350, to 500, to 1,000. Maybe Japan is the one that does hyperinflate.
Wow.
We've got to have that.
That would be one scenario for you.
Absolutely.
Full on Weimar style, but yeah.
And that's Bruce Kavanagh. Bruce Kavanagh, one of the greatest hedge fund managers ever, and he traded dollar yen from 300 to 100. When it was over 300, he's like, the voices in my head. I'm not the only one with the voices are telling me 100. And that was a remarkable statement because we were at 300. And he was looking at market pricing and trends and taking the logical deduction of where the market pricing and trends were saying most likely it was going to trade. It's not that hard. I wrote a kind of resignation letter to my hedge fund clients in the end of 2013. I said, you don't need me, the S&P's going up. S&P went up fourfold. People thought I was joking. Oh, the last bears turned bullish. Market must be about to. Market went up fourfold. You listen. The voices are very active.
Thanks a lot for this convo, and I much appreciate your time and.
Well, it's something about being in Amsterdam.
Thanks for watching. If you liked this episode, give it a like, and don't forget to subscribe. Leave your actions down below in the comment section. And if you want to watch more videos, feel free to check the most recent video, but also any other video that we've had published on the channel before. See you next time.